Welcome to KYC, Know Your Company. It's a show designed to give the regular investor powerful, actionable insights into single NSE listed companies daily. Now, today we're going to deal with one Mobikwik, recently listed. There's been just so much flip-flop with regard to the stock price. What should one do at this point with the company is what we'll try to give perspective to by the end of this show, and hopefully it adds value. Now, let's quickly look at what the company actually does. It onboards customers like you and me onto the app, very similar to what Paytm does. It was founded by Bipin Preet Singh and Upasana Taku, who are the founders, as well as continue to be those who are running the company. Both of them had experience in building scalable technology and financial products. So what they do is they onboard customers like you and me and thereafter cross-sell products to us. That's one part of their customer base. The other part of the customer base is merchants. They target the Kirana store next to your house, try and sell them products like the sound box, as well as card machines, and thereafter earn spreads on some of those products. They also earn rental yields on some of those products, and they onboard these merchants so that you can make payments to these merchants seamlessly. Thereafter, they also sell products to these customers. For example, loans, which a lot of MSMEs need at this point. It's one of the most underpenetrated spaces with regard to lending, and also investment and insurance products, which is pretty much to their entire base. 72% of digital loans disbursed are to tier 3 plus cities. So they're really catering to those who are underserved. That's really what they are pushing for. That's their forte versus a Paytm, where Paytm deals with a lot of tier 1 and tier 2 customers as well. Mobikwik has in its, it boasts that it does more of tier 3, tier 2, tier 3 and beyond. That's what really their target audience is. In terms of why the IPO, they wanted to invest, one, in research and development, especially with regard to the latest technology, machine learning, AI, and the like. They wanted to try and capture that opportunity. They also wanted to try and do capex with regard to the payments business and devices business rather, and then general corporate purposes. That's why they've done their IPO. IPO'd in December. Thereafter, it's been quite a roller coaster of a ride, I must say. Stock price ran up very quickly. Thereafter fell 60 to 70%. We'll talk about some of those metrics as well. But first off, let's talk about all the metrics that we're going to break down today with regard to one Mobikwik. And relevant because it's a platform company, and therefore it's unique in that sense. And all of the metrics that a manufacturing or a service-based company would typically, you or me would typically look for in some of those manufacturing and service-based companies, you would necessarily not look at in a typical startup platform-based company. So these are some of the parameters we'll look at. Income statement, balance sheet, operational metrics. Those are three metrics with regard to growth that we'll view, and we'll see as to how this one has done. Then we'll look at street cred, because there's been a listing in December and there's been large amounts of volatility on the stock. So we'll dive a little deeper into how that's played out. Shareholding pattern currently post the IPO, street coverage, street expectations, and thereafter we'll venture into the valuation picture. The most difficult of the lot, trust me, but we'll do a little bit of that, and we'll speak with an analyst, try and get a complete understanding of what this business is all about. So that's how we'll kind of break it up today. Let's start with the income statement. I'm going to try and ease this process. FY22, the number in terms of revenue from operations was roughly 527 crore. Saw a flattish kind of move in FY23, but the pump up has been seen in FY24. When you're looking at 9-month FY25, they've done pretty much the entire revenue of FY24 in 9-month FY25. So showcasing roughly a 33 to 34% kind of growth on the top line. That's how it's playing out. Talking about the expenditure and the move in which, or the journey of the expense, we've seen 659 crore of expense in FY22. We saw a bit of a taper in FY23 to try and recalibrate There's also an IPO which happened in FY25. So they wanted to kind of make sure that they are recalibrating their expenses in FY23. FY24, we saw a bit of a increase with regard to where total expenses was concerned. And therefore, how did profit before tax and depreciation look like at the end of all of these years? So the bump up in revenue has aided profit before depreciation and taxes. That number was at 18 crore in FY24, thereby aiding profitability of around 14 crore in FY24 versus the 8 crore loss in FY23 and FY22 of negative 128. I look at profit before taxes because a large chunk of the company for a predominant period of its life has been a loss-making company, and therefore taxes may not currently flow through. Therefore, as the profit normalizes or as the tax losses expire, you will likely have a tax impact on this profit as well. So currently, profit before tax equals profit after tax, especially for FY24, and you may see that for a few years going forward. Likelihood maybe 5 to 8 years. Thereafter, once it starts normalizing, you will start to see a tax impact on these numbers as well, and hence I've taken the kind of number that we have. So 14.1 crore, and now I'm talking about profit after tax for the moment, comparing FY24 PAT versus 9-month FY25 profit after tax or loss after tax. It's a loss number of 66 crore, but just let's deep dive on those numbers. Revenue moves from 875 crore to 902 crore. This is again 9-month, and therefore you likely see a bump up when you're looking at it from a full year perspective. EBITDA was positive, 22 crore positive number. Cannot compare that to FY23 and FY22 because that's an EBITDA loss number there. But margins now at 2.5%, which have slipped to -5 this year. You're also seeing profit after tax at 14 crore. We did speak about that in FY24. Currently sitting, because of the margin decline, currently sitting at -66 crore. Some part of this is also customer acquisition costs, and we'll talk about that in the operational metrics. But this is how the income statement lines up. A very decent set, a neutral on this count. They are very close to PAT profitability. Sustainable PAT profitability is what one would want to watch out for in this particular case. And there is no real guidance on that count, and we'll talk about guidance as well. So something to keep in mind with regard to income statement. You want to see sustainable PAT profitability. Let's talk about balance sheet, and this is a thumbs down for various reasons. Look at the way in which the equity has been playing out. It's fairly steady till H1 FY25. Still need to map out how H2 will look like, but we'll wait for the balance sheet to come out. Don't want to be too hasty to drop the balance sheet for the company, and therefore we've just kept it at H1 FY25, right? This is pre the IPO. Now, let's talk about shareholders' funds. This includes the reserves, which are on a declining trend, except in 1 year, FY24, where there's been around a 14 crore profit, and therefore you saw a bump up with regard to reserves. You'll also likely see in FY25 a bump up with regard to reserves because there was an IPO and shares were issued at a premium as part of the IPO, and therefore you'll see a bump up there. But for now, H1 FY25, again a decline because there was a loss in H1 FY25. Let's talk though about the more important aspects. Borrowing, long-term and short-term. Look at the split there. You're talking about long-term borrowing. Largely okay, right? No concern here. And I'll quickly contextualize this. You're looking at a company which has a market cap of roughly 2,200 crore, right? One Mobikwik, 2,500 crore to be precise. Apologies, stock price has also moved a bit. So yeah, 2,500 crore in market cap. Now, for a 2,500 crore market cap company, it's not looking too risky in terms of long-term borrowing. But what's really a concern is with regard to short-term borrowing. That one has been elevated at around 150 to 200 odd crores, so 10% of your market capitalization. What becomes even more cheeky is the fact that your short-term payables have have remained elevated for a prolonged period of time. So from 370 odd crore, it may have come down to 225 crore, but quite elevated in that sense. And your current liabilities, which are your short-term liabilities which you have to pay out, have gone are at roughly 600 to 700 crore. So something you want to keep in mind is that your payables are quite high. It's almost 25% of your market cap. What's the risk here? Well, we'll try and dive deeper into that. But broadly, this is how it's stacking up. That's why we've given it a thumbs down. Let's look at the comparison versus H1 FY25 as well. And numbers more or less there. Equity at 11.5, reserves at around 146, and therefore shareholder funds at around 157. No major change per se on any of those counts. The short-term payable is roughly 200 crore at the end of H1 FY25, and the current liability total is closer to 700 crore. So just keep that number in mind, and we'll try and quiz our analyst as well with regard to how does he look at this number. Now, let's talk about operating metrics. Now, here's a clear thumbs up because what we are seeing is very, very strong metrics across the board. Let's talk about it. GMV, which is gross merchandise value, which is the value on which one Mobikwik will be earning its revenues. Look at the spike up there in 9-month FY25. That's very, very strong. Platform spend GMV also has seen a very similar spike. It's doubled FY24 versus FY25. And the registered users have gone up in a fairly healthy fashion. They were at 12 crore at the end of FY22. They've added roughly 1.5 crore nearly every year. They've been jumping by around 1.5 crore every year in terms of new users, new registered users added. Merchants is the other contributing factor to both top line and profitability. So merchants have also continued to go up, 36 to 37 to 41 to 45. So they've continued to jump. Last off is merchant acquisition cost. This is the key because you can't just monitor merchants or customers added. You have to also factor in a cost associated with that. 17.5, 20.3, 33, and then in Q1, Q2, and Q3, it's been in the range of 34 to 37 rupees. And therefore, you might want to keep your eye out on that number as well. For full year FY25, will be very close to 35 to 36 rupees likely. So those costs have been climbing. And look at the climb between FY23 and FY24. That kind of shows and signals that there was a push in terms of requirement to add users and to add good value users on the platform. So that's something to keep in mind. How quickly does this taper will also determine how quickly profitability starts to get clocked in. So maybe one negative out of all the others, but otherwise operationally it's very, very decent kind of numbers that they are clocking. Now let's talk about street cred. This is an interesting one again, and we bring street cred early this time because it was an IPO. They've raised funds, and 279 was the IPO price. The listing price was 440, very healthy returns for investors. Listing day was 18th of December 2024, not too long ago, just about 3 months. And the listing close was 528. So real good money made for the IPO investor who would have exited on day one. But thereafter, we saw the stock peak at 698, and we saw 67% fall in the stock price to 231. From 231, again, the stock has resumed a rally, and it's closed, or it's currently at around 320 rupees a piece, 20% higher from IPO price in the last 3 months, and 24% up from the listing price. But that's exactly, 24% down from the listing price. But that's how the journey essentially has played out. It's a neutral here because just the amount of volatility would not signal any real direction. But it seems that at least some amount of money has been left on the table for investors to cash in on. And therefore, the IPO was okay. Let's talk now about shareholding. And this is post-IPO shareholding, right? So this is how the shareholding stacks up. You have promoters, which own around 25%. Then you have Peak XV and other funds, and these are funds like Bank of America who've invested, and they own around 28%. Around 10% has been held by Bajaj Finance, 9% by DIIs, and 5% by other FIIs. 23% is publicly held. It's a fairly rounded chart per se. Promoter holding is 25%. Now, when I compare it to other peers, other platform companies, which have burnt money over prolonged periods of time, made losses, that 25% holding is quite good in relative terms, because the dilution that some of these platform companies do is very, very high, especially upfront. And therefore, very unlikely that a promoter will continue to hold 25% of the company. But both the promoters continue to hold around 25% as we speak, and it was 30% plus pre-IPO. So a neutral on this count as well, not looking bad per se. Public shareholding is also decent, it's not too large. Of course, there'll be some investors who will want to exit from this basket, the Peak XV and other funds, but we'll have to wait and watch. So that may be a bit of an overhang. Also, we've seen lots of investors with who are locked in for 1 to 3 months, part of the anchor lock-in. Some of them have exited, and the volatility in stock price has also been caused by that. So maybe some risk here on this count, but some positive as well, and hence the neutral rating that we've given on this one. Last couple of quick pieces that we need to piece in together. One, the coverage. One analyst covers it, target price being 700, return potential being 115%. That's Rahul Jain, who's Director Research at Dolat Capital. He's going to join us shortly. Let's also talk about his expectations, and by default, this becomes the street's expectations. Let's talk about it. From 875 expected to go to 2278 by FY27. So maybe even from FY25, if you look at the forward, it's roughly doubling by FY27 over the next 2 years. Expenses also expected to grow at a healthy clip, from 1283 expected to go to 2204, slightly lower pace of expense growth. EBITDA expected at -86 for this year, but expected to turn positive by FY27. FY26 was also a positive number, and profit before tax also expected to be positive for FY26 and FY27. Profit after tax also expected to be positive for FY26 and 27. But FY25 is that muted here in which they have listed themselves. Quickly on to valuations. And this one is a thumbs up, and I'll tell you why. FY25 price to sales, Mobikwik currently sitting at 2.2 times, and Paytm, which is the nearest compete, is at 5.5 times. So what you're seeing essentially is that Mobikwik is at least 50% plus cheaper than a Paytm at this point. So there is considerable opportunity available. Of course, Paytm has deeper moats in that sense, larger user base and the like, but nonetheless, valuation, purely valuation-wise, Mobikwik is looking more reasonable. Let's talk about guidance before we move quickly and speak to Rahul Jain, who's waiting by. IPO proceeds to be utilized for growth and expansion. We've spoken about this. Looking to add 5 million users, which is 50 lakh users each quarter, so roughly 2 crore users a year. Company onboarding 1 to 1.5 lakh merchants each year. Optimistic about growth in payments. Products, well, new product in UPI to drive growth likely, and there are a couple of products there. Launch of new insurance and savings businesses in 2025, also monetization and profitability. Customer costs have increased but remain competitive compared to peers is what they suggest. Financial services take rates have gone up. This is the key, whether MDR can continue to help that number. Expect a rebound post decline in disbursements in certain lending products, so that should aid numbers. Fixed costs expected to remain stable, so costs also stable. Larger ticket sizes to aid yields, they're focusing on that, and 40% of disbursements are under first loss default guarantee. This will mean that they will take guarantee for the first piece of loss on the loans that are disbursed through the platform. This is a key risk to profitability in case cycle turns bad. So that's how it's playing out. Let's quickly look at the ratings. There you go. So income statement, neutral, balance sheet, operational metrics, street cred. Let's quickly go on, and shareholding, street coverage, street expectations, and valuation picture is a positive. Overall, it's a 4.5 on 8 on this one Mobikwik. But let's quickly go across to Rahul Jain, Director Research, Dolat Capital, who's here to talk to us. Rahul, uh, good morning. I want to first talk about what's the risk to the estimates you have plugged in. We've spoken about those estimates right just before this conversation. Not sure if you had a chance to listen in, but what's the risk? What's the key risk in your view?
Yeah, I don't see much risk to our estimate what we have built in. As I could see from some of the charts that you were displaying, it was showing roughly 90% jump from FY25 to FY27 in our revenue estimate. And profitability, as you would see, are something which is they are just around the break-even point. They did a small profit last year. They slipped back into negative this year. So they are just around that corner. But most important thing that we need to keep in mind is that the IPO inflow of roughly 570 crore. That is a huge amount if you look at the balance sheet of the company prior to the IPO, which was around 850 odd crore. So that is a good 60-70% jump in the balance sheet size. All of this money will come into some kind of business expansion strategy as they have already identified in their usage of fund. And that will actually expand their canvas in terms of how to get into different revenue streams and increase the per customer value. If you look at for Paytm, the per customer value is around 1,000 rupees revenue they earn per customer. For Mobikwik, at this point is closer to 400, 450, and that needs to go up 2x. And of course, the number of consumer expansion would happen because the UPI penetration for them has started more recently with an innovative product. So I think they have a very long way to grow in terms of scale, both from user perspective, revenue per customer perspective, and number of use cases perspective. So those are the driver to our growth estimate
Hmm. And Rahul,
looking into the future.
Rahul, would that also be a fair comparable? Because Paytm's customer cohort is a higher value customer as well. Can a one Mobikwik scale from 450 to even closer to 1,000, given the customer cohort and given that they are more focused on tier 2 and beyond?
Yeah, I would say from an incremental point of view, they want to focus in tier two, tier three as well. But it's not that they're not present in the bigger cities because it's a old business and most of the early users all came from tier one, tier two cities for any wallet kind of a use case. If you look at right now, they have significant market share in terms of the wallet users. And that clearly talks about they possessing some high frequency user as part of their customer pool. And it's not about tier one for Paytm versus smaller tier for Mobikwik. I don't see that kind of a distinct customer base. So ARPU can increase. Of course, it may take time to reach that 1,000 mark because of the number of use cases could be much, much more in case of Paytm. But if you look at the bigger use cases, which is around payments, UPI, credit card, lending, I think those use cases also exist here. The marketing business, which Paytm has, which has ticketing and those kind of use cases also, which is relatively a smaller business for them. That point business do not exist for one Mobikwik right now. Also, another business which is around the device subscription, which is very subscale at this point, but they have articulated a strategy from the IPO proceed to get into the devices business. That would also increase the ARPU or a use case and increase stickiness for their merchant base. And that further drives into financial services opportunity for those merchants. So that way, the stage is set. Of course, execution need to be seen. And we are hopeful that they will do a good justice of the capital that they have raised. And that's why we don't see risk to our estimate of 35-40% kind of a growth for next couple of years.
There have been deficiencies, irregularities in managing records with the RBI, Rahul. Now, regulatory concerns in this industry are in any case elevated. Plus, you have the MDR overhang, which doesn't seem to be going away. Every time we're talking about a possible MDR, it's been quashed. What's the sense with regard to some of those levers, and how much of the MDR is factored as part of your estimates in your top line, or is that not?
Right. So, firstly, on the regulation front, if you look at any sunrise industry, you should appreciate that the industry gets set up first, and the norms or regulation come later on. And as the business become of a certain scale, regulator come into picture, and then they define the borderline. And so all this innovation happen around in an area which does not pre-exist. So once the rules are formed, you are seen either on the right side of it or on the wrong side of it. And we have seen with all the fintech company that they have eventually been on the wrong side of it, at least for one or the other reason. So that I think is part and parcel of any business which is getting created, any industry which is getting created for the first time. So most startup would have to deal with that, and we have seen it with all the top 10 fintech probably in India. Moving to the MDR element, I think it's a very welcome move that has happened where the government has
Yeah.
notified that a small merchant and small value transaction would get incentivized by the government.
Hmm.
They not clarified in terms of what happens to larger transactions,
Hmm.
what happens to the transaction which are done at larger P2M. If the conventional wisdom has to go, it has to come because that is a segment where you need to get the monetization done
Right.
because they're a large merchant and they have the wherewithal to deal with it. So, of course, we don't want to get into that speculation, and
Hmm.
that's why we don't build that into our estimate, even
Sure.
for Paytm, even for Mobikwik.
Sure.
But yes, we know that is a big optionality. If
Sure.
that comes in, some people could be significantly beneficiary, and Mobikwik also will be a little bit beneficiary in that case.
Sure, sure. Thank you so much, Rahul. Completely out of time on this one. But thanks for coming in, giving us your views with regard to one Mobikwik. And we've tried to break this down the best we can. So thanks for joining us. But with that, completely out of time on this edition of KYC. From myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.